Hello, hello, hello. What's going on, everybody? Hopefully you guys can hear me loud and clear in the YouTube world. You guys should be able to see just the screen here with a little bit of text that I've written out that we're going to be explaining as we dive into the webinar. But anyways, welcome to a Capital Hungry Market Update and Trade Ideas webinar. It is currently 5:40 p.m. Eastern, Tuesday, January 24th. So before we jump into this market update and trade ideas webinar, I just want people to understand in terms of impact on US dollar, on US equities, on gold, and of course on dollar pairs, what has been holding the most weight. For those of you who are unaware, after the dollar domination phase of 2022, when the Federal Reserve was front-loading rate hikes and the markets were pricing in that information accordingly, during November 2022, we started to get a sentiment shift. This is what was called and coined the Fed pivot narrative, right? Hopes that the Federal Reserve will pivot. Since November 2022, the hopes of Fed pivot has been driving the markets. Order flow has been pricing in potential chance Fed will pivot and loosen financial conditions and go against their rate hike cycle based on two main catalysts that have been supporting that. Either one, continuing declining inflation data showing that the Fed's job is starting to actually take place and the front loading of rate hikes is doing what it's meant to do. Or two, recession fears data showing that the US economy is being deeply impacted by the front loading of rate hikes or overall digging deeper into a recession where it cannot handle any more rate hikes or keeping rates hiked for an extended period of time. Since November 2022, this sentiment has been holding the most weight as month over month we've had improving inflation reports and worsening other economic data such as PMI figures, retail sale activity, consumer consumption, and so forth. The impact on a macro perspective since November has been dollar bears, stock market bulls, and gold bulls. Even though this week we have a Fed blackout, which means no Federal Reserve speakers as we wait for FOMC this next week, we have a lack of fundamental events as majority of the inflation figures, retail sales data has already been released and the market's priced in. Even though we may have lower volume and volatility, this is still the main narrative that's holding weight in terms of gold, stock market, and dollar pairs. We're still in a gold bullish bias, stock market bullish bias, dollar bearish bias, which means GU bulls, EURUSD bulls, and USDCAD bears, okay? We haven't had any fundamental catalyst or reason to be bringing back dollar domination. We haven't had increasing high CPI reports. We haven't had very optimistic improving economic data. And we haven't had any new hawkish events brought by the Federal Reserve. Maybe next week with FOMC, the Feds will bring the heat back to the table in terms of bringing the hawks and further putting pressure on the rate hike cycle. And that can be a catalyst next week to bring back dollar strength. But this week and the previous weeks, we haven't had anything to take away from this. So the main reason why gold has still been respecting beautiful bullish structure, is still in a very beautiful bullish trend, and we're going to be looking to extend this, is the Fed pivot narrative based on declining inflation figures and US recessionary scare data. This is the same reason why dollar is bearish and just ranging at technical intraday lows printed, as we just have less volume and volatility. This is the reason why EURUSD is still very bullish on the intraday timeframes and in terms of price action and market structure. This is also the reason GBPUSD is still very bullish, sitting at previous intraday highs. USDCAD more bearish, and US 30 stock market index still very bullish above this demand zone at 32.8 and well above 33K. We can see as there's less demand in the dollar, more demand in other asset classes and risk assets based on the hopes of Fed pivot. Global equities are still holding relatively bullish here. And you can see the volatility index very flat. Now, outside of the US dollar pairs, gold, and of course, outside of the US dollar pairs, gold, and of course, US equities, the other main currency pair that we trade and give analysis for is GBPJPY. The main fundamental driving factor in terms of GJ movement over the last couple of weeks has been Bank of Japan sentiment. Yes, Japanese yen has had a pullback phase here to start out this new year, but as we had the Bank of Japan still keep their monetary policy loose, still keep easing of the monetary policy, and of course keeping interest rates in the negative, this is still keeping the Japanese yen bearish with potential to double top or just continue further bearish. So I'm still in a higher time frame. An intraday GBP/JPY bullish bias as long as yen stays below 78.6. So now, before we jump into some of the trade ideas and what key events we have, keep in mind a couple of things. We have a lack of fundamental events in a Fed blackout period, so market volume and volatility is a bit lower and slower. Hence, EURUSD is ranging, dollars ranging, volatility indexes ranging. Stock markets aren't seeing monstrous upside, still in a bullish range. EURUSD is ranging and so forth, right? From a technical price point perspective, as long as dollar remains below 102.5, we're still bearish. And even better if we can start breaking below these range lows at roughly 101.7. Still looking to play the bearish bias on dollar. In Japanese yen individually, as long as yen is holding below 78.6 or even driving lower to potentially 76 down, we're still in a bearish bias on the yen individually as well, primarily being driven by a dovish Bank of Japan monetary policy, as they're still keeping loose financial conditions and potentially ready to ease monetary policy even more if need be. Volatility index isn't showing us any major fear as long as we're still trading below 22.5. And if we start trading below 18.6, shows even more optimism in the stock market. This can be very easily correlated when you're looking at market structure, that it's hard for me to see any sells on gold unless we're trading well below the 1900s or have a fundamental catalyst for sellers to come into play. We may not see a fundamental catalyst for gold sells until next week's FOMC, where the Feds may bring a hawkish sentiment. Otherwise, buyers are continuously printing higher highs. We're just having secondary phases of market structure, which can be an order block and accumulation of order flow, or pullback phases, and we still end up continuing further bullish. You can see very similar type of structure as the Fed pivot narratives holding the most weight, and GBPUSD is very bullish still, well above 1.21. EURUSD, similar idea, as we're very bullish still, well above 1.07. So we don't want to fight the current fundamental sentiment on dollar pairs, gold, and stock market, which is the Fed pivot narrative, and data as well as order flow supporting that. And we don't want to fight the bullish trends on EURUSD, GU, gold, or the stock market. And on the inverse, we don't want to fight the bearish trend on USDCAD, obviously as dollar is the primary in this quote, and it's a lot more bearish, right? On GJ, I'm still sticking to a bullish bias as long as we're holding above daily demand zone 156. Japanese yen still stays bearish. And of course, we have expectations of a more hawkish sentiment from the Bank of England in the coming weeks. But GJ, I'm still in a bullish bias as we have more demand in the risk currencies. Yen is turning bearish ever since last week with the Bank of Japan sentiment. Okay? Stock market halt during NYSE. We were trading US 30 during NYSE and we did not see any halt or stoppage in price or any news related to that. Maybe some individual stocks were halted in their trading, but the entire index as a whole was relatively very active during NYSE. Yes, we have lower volume and volatility, but we still got the NYSE pullback to this intraday range and breaks back above 33,500, still extending higher here back to the highs printed from previous week in terms of equity movement, right? So now, before we jump into the individual technical and fundamental analysis, looking at market structure, price points of interest, we just want to understand what events we have on the table or what lack of events we have. As the title states, I'm expecting personally lower market volume and volatility up until next week. This doesn't mean that we can't just continue the gold bullish trend, but I'm not expecting any major impulsive moves. I'm expecting us to continue chugging away to the upside in this fashion up until we have any order flow confirms next week or fundamental confirms with FOMC. So one thing, we have majority of fundamental events priced in, a Fed blackout period, the World Economic Forum meeting is completed and over, markets are showing less volume and volatility. As manual retail traders, we want to stay adaptive to those conditions. Where there's higher probability, pullbacks can take place. Where there's higher probability, we may not see huge impulsive moves. Where there's higher probability of ranges that can take place as well. So compared to when you're having fundamentals in play and impulsive moves with trend, you want to adapt to the periods of secondary phases of market structure, such as consolidations or pullbacks accordingly as well too, which we may see this week, right? We're still sticking to the same bias, dollar weakness, still sticking to the same bias, gold bulls, GU bulls, EURUSD bulls, UCAD sells, and US 30 bulls, but just have expectations volume may not be the highest till post FOMC next week. Now, besides that, let's look at what events we have on the table tonight through the Asian session, as well as through the Euro session and New York tomorrow. Okay? So we have some CPI reporting with Australia here through the Asian session. Inflation figures still expected to be high, showing that the Reserve Bank of Australia needs to do some more interest rate hikes, but nothing much going through the Asian session. Overnight through pre-London and London hours at 2 a.m. Eastern, we have producer price index reporting from the UK. This honestly won't have that much market impact, as the main focus on inflation side has been the consumer side and the CPI readings, which we've already had the UK CPI come out a few days ago or last week, if I'm not mistaken. At 4 a.m. Eastern, we have some business index reporting for Germany, which will be impacting euro pairs, expecting some rebounds, which can keep EURUSD more bullish, EURUJPY more bullish. During our New York session, we don't have anything going on in terms of US economic data, but we have the Bank of Canada rate decision tomorrow. Now, the Bank of Canada rate decision is already expected to do a 25 basis point rate hike, and that information is well known and priced in. If they just do what's well known and priced in, a 25 basis point rate hike, the Canadian dollar will actually weaken in the short term. As that information's been well known, the market adjusted to it accordingly, right? If they do a surprise higher than expected rate hike, that can lead to some more Canadian dollar strength individually. But in terms of economic events, central bankers, geopolitical tensions, very quiet start to the week, not much going on, hence the low volume and volatility, right? Now, let's just go through the analysis on the individual pairs and trade ideas. Gold, as on the higher time frame, has from November onward, has been pricing in the Fed pivot narrative, completely correcting the dollar domination phase, which we played during the 2022 period when they were front-loading rate hikes, right? When you're looking at gold now, we're holding above potentially very key zones on the higher time frame that we've actually broken and retested, and we could easily still be digging into the 1950s and 1960s, especially when you're looking at some of these zones to the left, right? So personally, as long as dollar still stays weak, we still see demand in the stock market, gold doesn't break this bullish structure, even if it gives another pullback to 1920, it is still very much bullish. We have bullish price action, bullish market structure, still some high points to revisit, and of course the fundamental narrative holding the most weight, which is the Fed pivot sentiment and Fed pivot narrative. When you're looking at the intraday time frames, we're just having buyers print consecutive higher highs. And as we print these higher highs, we have pullback phases. Once these pullback phases are complete, driving price down to more favorable demanded price points of interest, or we have a consolidation phase and a breakout, you can see we have nice continuations with trend. Today, during the US North American trading session, right, from this high printed by buyers, we had a short-term pullback, which was primarily induced by some minor rebounding PMI figures. Nothing crazy, nothing substantial, still very well below the recessionary scare points, and still overall pretty bad data. All this did was lead to a quick liquidity grab on dollar, and then dollar strength got faded out and sellers came back into play. And on gold led to a liquidity grab here before buyers came back into play, right? We can also see very strong bullish market structure, very nice demand areas in the 1900s and 1910s that are being respected. When we're bringing that information together to the table now, I don't think we're going to get a full pullback to the 1920s again. As you can see, we've already grabbed liquidity here a couple of times, but that would still be a very viable option, and we don't have any reasons to sell unless we're breaking below 1912s. So I'd only be selling below 1912s. Otherwise, pullbacks to 1923, 1929 key level, and also just having the daily candle make a lower wick, grabbing some more liquidity, and flipping bullish back above these intraday highs at 1939, I would still be looking to play gold buys. Fed pivot narrative holding the most weight, less demand in the dollar, other risk asset classes or other asset classes seeing more investment activity such as crypto, oil, stock market, and we're still in very nice bullish market structure, bullish trend with bullish price action, validating liquidity grab from these areas from the previous days. I could only sell below 1912, or maybe I could see sells if, again, we come up and drive into that 1960s area and start to get major signs of rejection. But I still see upside ranges into the 1960s. Okay? Just got to keep in mind lower volume and volatility, Fed blackout period, higher probability we can see pullbacks and things of that nature as well. GBPUSD. Now, GBPUSD, as we had this high printed, coming into 2023, we just had a pullback phase setting up order flow for the new year. This drove down to roughly 1.19, where dollar weakness extended further with the Fed pivot narrative holding the most weight. You can see we have enough order flow to at least revisit these highs. I can see us trending to these highs, but further buys would also be validated by breaking above this price point. I would not be surprised to see EURUSD starting to range at these highs as we have less volume and volatility, and dollars also ranging at its lows with a lack of fundamental events in focus, and investors in smart money waiting for FOMC and other important rate decisions in the coming weeks. Nonetheless, I still want to play the dollar weakness bias and potential buys back into these highs. If the new daily candle double bottoms and holds 1.23, breaks above 236 and above 2415, I would still be looking for GBPUSD buys. Dollar is still bearish on Fed pivot narrative. We're seeing more demand in your basket of risk currencies, which GBP is a part of. We're still having a pullback from new intraday highs printed. Very bullish market structure and bullish price action on the intraday and higher time frame. I could only see GU sells if we have any geopolitical tension maybe come out overnight, like, I don't know, China starts physically attacking Taiwan and finally starts invading Taiwan. or we have any other geopolitical tension that can bring fear, uncertainty, and doubt and take away demand from your risk currencies and bring demand into dollar as a safe haven currency, or technical breaks below 1.224. Euro USD is a very similar idea, but even in a stronger bullish trend with new intraday highs printed here and expectations of more rate hikes to come from the ECB, as they have been a bit behind on their rate hike cycle path compared to the Federal Reserve and other major central banks. But double bottom pullbacks to 1.085, holds above 1.087, breaks above this medium term zone, I would still be looking for Euro USD buys to revisit these high points printed here. You can see the liquidity grab that took place with data and got faded out. Dollar weakness still holding the most weight in terms of intermarket correlation. And of course, we still have more hawkish ECB. Euro PMI data was not terrible and relatively neutral, and still very strong bullish market structure and price action. I would only be looking for sells below 1.079. USDCAD is more of the inverse. Now, we are doing a similar type of price movement compared to the dollar, where we are just ranging at intraday lows, but still very bearish with the profit taking we've seen from the highs and ever since the Fed pivot narrative has been holding the most weight. If we cannot correct this downside move, and especially if we start breaking below this support level in range low, we have still ways to go to revisit potentially 1.325, playing the dollar weakness bias, as well as Canadian dollar having a little bit more strength with oil rebounding. But keep in mind, there's a high probability UCAD will range until the Bank of Canada sentiment tomorrow morning. Bank of Canada rate decision at 10 a.m., which I talked about when we were breaking down economic data. But otherwise, if we do get some nice movement, I'd be looking for pullbacks to 3.4, breaks below 3.36, and breaks below 3.31 sells. I would only look for any type of UCAD buys depending really on the Bank of Canada rate decision tomorrow. If they bring a dovish sentiment, I would look for UCAD buys above 1.344 and 1.35. Dovish BOC. Okay. Last but not least, out of our asset classes that have been primarily impacted by Fed pivot narrative. Again, since November 2022, you're going to see from November 2022, when the Fed pivot narrative started holding the most weight, this is when dollar turned bearish, stock market bullish, gold bullish, and so forth, right? Japanese monetary policy holds more weight than UK economic data in the short term. As long as we're still holding above that daily demand zone, we still have potential to revisit these range highs as volatility index is bearish. Global equities are still seeing continued demand. We still have weakness in the dollar and the Fed pivot narrative holding the most weight. In terms of trade ideas, I'd be looking for retests of 33,400, breaks above current rejection point at 33.8, and breaks above 34K buys. As long as VIX stays flat, we don't have any reactive geopolitical tensions to bring fear, uncertainty, or doubt, and dollar still stays bearish, would be looking for these buys. I only see stock market sells maybe if we reject the same highs again and see buyers liquidate positions, or if we break well below that daily demand zone at 32,500, which more than likely would be induced by a fundamental catalyst of either a very hawkish FOMC next week or any type of geopolitical reactive tensions that can take away demand out of the stock market. Like an example would be if China starts to invade Taiwan or something like that. Okay. Now that was the trade ideas and analysis on everything being impacted by the Fed pivot narrative, primarily US dollar, dollar pairs, gold, and US equities. In terms of GJ, the main fundamental factor holding weight is the Bank of Japan's loose monetary policy and rate decision from last week, and the focus on Bank of England rate decision in the coming weeks, where they're expected to still be more hawkish. When you're looking at GJ, it's very common that you see these sporadic waves of price, as overall from the pandemic here, we've still been very bullish, right? We've still had buyers print these significant higher highs, but it's very common that either you have fear-induced catalysts such as currency interventions by Japan, or any short-term fear, uncertainty, or doubt, or even here, which I saw as setup for order flow for the new fiscal year, it still didn't break this key demand zone at 150 or the key demand zone at 156. So when I'm looking at GJ, and I want to show you guys a previous historical run from these lows as well, you can see it's very, very similar. Look at this run after the 2008 global financial crisis, right? You can see periods of heavy consolidation, huge pullback waves, and huge pullbacks to previous demand zones. But as long as you don't break that bullish structure on the higher time frame, you continue to chug away the bulls. Very similar type of sequence of events we're seeing compared to that historical run post GFC crisis 2012 onward. The only reason we saw this downside after the run was because Brexit came into play, and that was a whole new reactive event for the markets to price in, with the UK wanting to leave the European Union. But if Brexit didn't happen there, GJ would have just kept continuing bullish as the fundamentals were bullish, right? Here, the pandemic has been priced in, Brexit has been priced in, and what we've been riding here is a more hawkish Bank of England in an active rate hike cycle and a more dovish Bank of Japan. On a daily perspective and higher time frame perspective, as long as we're holding above that 156 demand zone, GJ is very bullish and can easily be trending back into these highs printed by buyers, as long as Bank of Japan keeps monetary policy loose and Bank of England brings more hawks to the table, right? So you can see very key demand zone and liquidity zone here, very key demand zone and liquidity zone here. Also, after this new year price setup, which was induced by a Bank of Japan fear headline prior to the rate decision, that got completely faded out as Bank of Japan kept monetary policy loose. We have a double bottom showing there, showing us more buy orders being collected, where if we don't correct this downside move, we can be trending back to correct back into the 166s. On the intraday timeframes here, when I'm looking at GJ, you can also see stronger bullish market structure forming, but I would also like to see upside breaking above 161.3, which would validate a lot more buyers in the market. Nonetheless, if GJ gives us daily pullbacks to 159.8, breaks above that rejection point at 160.8, trading above 161, I would still be looking for GJ buys as long as we don't have any fundamental fear catalysts. The UK PMI data was priced in. Weak yen is still holding the most weight. And we're still respecting bullish market structure and higher time frame bulls. I would only look for GJ sells below 159.5. Okay? So keep in mind, the Fed pivot narrative is holding the most weight on US dollar, US equities, and gold. This narrative, supported by data, is keeping dollar bearish and the stock market and gold more bullish. The data supporting that narrative is declining inflation and US recessionary scare data. On terms of the Japanese yen, Bank of Japan's monetary policy remaining loose is keeping yen bearish. The main focus points are at the end of this week, which is of course US consumption data and US consumer confidence report on Friday. Otherwise, we have a Fed blackout period, lack of fundamental events, lower volume and volatility, so stay adaptive to those conditions. I'm going to save and upload this. You can always rewatch it as you wish. Please send a like, subscribe, leave a comment on the saved webinar, share this around in other trading groups and other communities. It's free to do and really helps the channel grow and gain more traction. A lot of my social media is shadow banned because I talk about masculinity. I have a very aggressive tone. I swear a lot. I go against the mainstream agenda of pushing weakness and consumption. So a lot of my shit is shadow banned. So any type of sharing of my content and sharing it around or liking and subscribing helps a lot. All right. Next week, I'm also going to be potentially bringing back some of the scalping sessions for New York on like every Wednesday. So I want to, as soon as I get some of my day-to-day life, as soon as I get some of my personal life shit fixed up and sorted out for this new year, I'll have a lot of personal things going on right now. But as soon as I get that stuff fixed up, I want to stick to a schedule of Monday market updates like this, like during the evening, like for me in the Eastern Standard Time Zone. Wednesday, New York scalping sessions from like 8 a.m. to 9:30 or 10. And then a Friday IG live question and answer period. That's what I want. That's the schedule I want to consistently stick through for the year of 2023 in terms of content for the free community and people out there. But I'm not ready yet, as I have some personal things I need to get fixed up and sorted first. And then I'll be good to go with all that stuff.